Hi, I'm Emma Wall, and joining me today is JP Morgan's Karen Ward to talk about the outlook for the global economy. Hi, Karen.
Hi.
So we last spoke, or at least we last did a video in November last year, thinking about the outlook for 2020. I don't think anyone could have predicted quite how the first half would have turned out. And therefore, I would understand if you were reticent to give an outlook from this point. But I do think it's important for us to talk about where we go from here, because there's a lot of analysis that's been done of what's happened to markets so far. But what are you thinking as an economist about the future?
I think you're right, Emma. No one knew there was a global pandemic coming. But I think even if you were given that information, would you have then said that by mid-year markets would only be down 10%? I'm not sure many would have forecast that. And I think we have our global policymakers to thank for that. I think what the market is expecting, the reason we've seen such a phenomenal bounce back, is the market is expecting that policy to have worked almost perfectly. And therefore, these bridges they've tried to build from one side of the virus to the other will prove entirely effectual, and the economy will be bouncing back rapidly from here. I'm a little cautious that things are quite so smooth. I would argue that it's going to be V-shaped by nature. It has to be after such a plunge. I just think the other side of the V isn't going to be quite so symmetrical, largely because I think, there will be some scars. There will be some unemployment, unfortunately, and that will take a little bit of time to work through. That will constrain spending. There will also be some debt. I mean, that's the only thing we probably really do know post-COVID-19. We're coming out of this with a lot higher debt in the private and the public sector. I don't think the public sector is going to worry too much about paying it down. I think the floodgates of fiscal stimulus and chancellors are enjoying their time in the sun. Everyone likes a chancellor who spends money. No one likes them that take it away. And I think they're not worried about debt anymore. So I don't think we're entering a new phase of public austerity, but I think the private sector is going to have to work through some of that debt. And that, again, is just going to restrain investment, restrain employment. So it's going to be a bounce back, but I just think it's going to take a little bit more time for us to get back to that period of absolute normality.
And what key indicators are you looking at? Because, of course, here in the UK, things like employment figures have been slightly greyed out by the furlough scheme, whereas in the US today, on a day that the US has just announced new unemployment figures up again by another couple of million. What are you looking for then, either to confirm things that you're already thinking or indeed to sort of see those green shoots?
You're right. We're in a whole new world of looking at completely different data sets. So one of the things we're providing for our clients, for anyone who would like to take a look on our website, is some of this new real-time information. So tracking the level of activity. So mobility data. How are people moving around? And where are we relative to normal, relative to where we were before? And how does that differ for different parts of the economy? So we can see that people are feeling happier about moving around. We've seen mobility actually pick up substantially, but it's going to parks. It's not going back to restaurants. We know that that's going to take a lot more time before social distancing really ends. So we have totally changed the data we're looking at, but then it is still, I think, digging through some of that labour market data, trying to understand whether it is permanent unemployment. But you're right, it's a very unusual situation, and the data that we're focused on is different.
One of the things that we've talked about before that I know you looked at previously were things like commodity prices. Obviously, the oil price has had an exceptional journey over the last couple of months, triggered by coronavirus, but then exacerbated, obviously, by the indecision between Russia and Saudi. How are you interpreting things such as those, such as commodity prices, into your analysis?
Yes, I think you're right. It was part of the story because of the demand contraction that we saw, but then overlaying that, you had those additional complications as those key producers, the discussions between them broke down. I think with regards to the oil market itself, I think as the economy, because, we do see the recovery, we just don't think it's going to be, back to normal by the end of the year. So as demand recovers, then that will start to feed into, I think, the higher oil prices. Also, I think that the big producers, which have clearly not been able to agree on supply reductions, that will have to change over time. None of those can sustain low oil prices for a significant period of time because they need the income, whether that's for their government spending programs or just, broad break evens. So I do think we will see oil prices move a little bit higher. That's being said, I think that the sustainability, the focus on climate change, the idea of seeing oil prices back above $70, I think those days are long behind us.
And you mentioned climate there and ESG. One of the things that I think is quite interesting about a period of time, a series of events such as the one that we're living through at the moment, is they can either interrupt or indeed accelerate global themes and trends. What are you seeing in terms of demographics, ESG, that the coronavirus is impacting?
Yes, well, I think actually it's on the E, the S, and the G. We've learned a lot about the importance of company level screening. So, for example, governance, companies that have been well run, that have maintained good balance sheets, that we then categorize as quality companies, have performed in this recession. So the good screening on good governance, I think, has demonstrated that those companies deserve a premium and will continue to. I think there will be some significant social dimensions to this. How companies treat their employees through this crisis, and then how that translates into a broader brand recognition. I think that's going to again intensify. And then with regards to the environment, I think many people have sort of assumed, well, this probably puts climate change on a back burner, because if we suddenly all can't move about and get in planes and go in cars, then maybe we are, it's less of a focus. I don't think that's right either. I would say that the focus and the agenda is still very much there. And in fact, what this crisis has done, as I said, one of my key points is that governments aren't worried about debt anymore. So they're happy to, it seems, spend money left, right, and centre. And therefore, the infrastructure they were planning to transition our economies to zero carbon, I think that agenda will accelerate as well. So I think it's demonstrated the worth of screening on these categories. And I think that only exacerbates a trend we've been highlighting, which is further, appetite for these kind of ESG screened funds.
I completely agree, because anecdotally, I remember the last recession, the global financial crisis, ethical investing was still really relatively new. And what happened in 2008, 2009 knocked it from the agenda in terms of things that both individual and professional investors were talking about. Whereas actually the spotlight seems to be shining brighter during the last 3-4 months on ESG. It hasn't knocked it from the agenda at all. In fact, it's brought it up the agenda.
Exactly.
Karen, thank you very much.
Thank you.